The Aussies are coming for our commercial property, and today we're going to find out exactly why. We've got Scott O'Neill in the studio from Rethink Investing NZ. Mate, good to have you here with that Aussie twang.
Great to be here.
Talk us through what you're doing in New Zealand and a little bit of context for that hook of an intro there.
Yeah, it's a great hook, and it's true to a degree, but we are here to help New Zealanders mostly, like about 80% of our work is that. But long story short, we are trying to bring the buyer's agent model back into New Zealand. It's been around in Australia for about 20 years, and a large percentage of people now use buyer's agents not only to buy homes, but investments, and we're specifically commercial property. And we've found since getting here, number one, there's not many people talking about commercial property because it's all so residential focused. And then number two, not many people know what a buyer's agent is. So it's just a real big awareness program. And once people know what the service does and the benefits, it's going to get a lot of popularity, as it already has been.
Well, I'll ask you that question, what a buyer's agent is, and we'll explore that very quickly, and then we'll get into a little bit of your background. But maybe what a buyer's agent is, and then what you are seeing on the ground here in New Zealand in that commercial property space.
Yeah, so buyer's agent, and I'll talk about a commercial one because that's what we are in New Zealand. We basically are like investment advisors that go help you spend your capital the best possible way. So you might say, I've got a $1 million deposit, if you're lucky enough. Where do I get the best return for the money? Is it industrial? Is it in a little neighbourhood shopping centre? Do I go South Island, North Island? Like wherever it is, we use the local experts to sort of find out where the best amount is. We talk to lenders, so you might use that $1 million to then get a bank loan, and that will allow you to purchase up to, say, a $2.5 million price point in that range. And it's all about just getting the lowest risk possible with the highest return, the best upside, capital growth, all the usual stuff. You've got to mix it in there. And there's some really good deals around there because of where the economy is at the moment. And obviously your official cash rate is coming down pretty quick from a high number, mind you. But that in itself is one of the reasons we're here.
Yeah, well, we'll explore that in a bit. But should we explore, firstly, how you came to get involved in this space? And we'll go down that path.
So my journey started... It started all the way back when I was an engineer. So I was out building railways and bridges for a big multinational company. And, it's not really a sob story, but I really didn't like my job. It was motivation, I guess, to look for other options. And so I looked into stocks, and I loved doing that from quite a young age, and thought, how can I scale this investing strategy a little bit more? And naturally, you default to residential property. And I used my salary at the income to leverage off that, go to the banks and purchase my first property when I was 23. This was in Sydney. This is a while ago now. So that was 2010, just after the GFC. And that was an interesting time to buy because they said, the world's coming down from a financial sense. It was really risky. There's no growth. It's all going to crash, all that kind of stuff. So it got me in the mindset, what if it doesn't grow? I need better cash flow. So even though I went down residential, I found special types of residential properties. Like it might have had a house in granny flat or unit blocks where, multi rooms or multi leasable properties on one title. And all of that kind of allowed you to get a bit of a better return. And that was important because I didn't want to negatively gear because I saw the damage, like my father got stuck into that trap where had a decent income, but like all of it was just going to service his property loans. And, when the growth stopped, it wasn't a great outcome at all. So I just thought, all right, I've got to buy the right types of properties that even if it doesn't grow, you're still making money on it. And after a few years of going down that residential route, there was a lot of growth, which was great. So that was building equity, and I was recycling that to go into more and more deals. And 5 years after purchasing my first residential property, I think I was up to about 18 or 19 properties by then. So
wow,
it was working pretty well. And I was chasing pay rises in the job. I moved to regional areas. So I was doing value add strategies. I was, everything from sanding floors to replacing kitchens to strata titling unit blocks, making them, multi-titled, and then you can revalue those up. So I was always very active, and this is all in the background with the job. And then got into commercial, and that's where it all changed because the returns they're like 2 to 3 times better than the best residential property. And put that in perspective, like, look at Auckland, for example. You might, how everyone quotes like the yield's 5 or 4%. That's really a gross return. So you got to I guess, pair that back to net returns. So by the time you pay your maintenance, insurance, property management fees, all of that, plus all the other costs that go into it, you're really going to be sitting on probably a 2.5% net return. But I was buying commercial properties with 7, 8, 9, 10% net returns. So multiple times better, and the equation got pretty good after that.
Well, I suppose once it starts compounding as well, the growth is so much faster than that resi space. When you've come to New Zealand, have you noticed that we are pretty down the path of A, residential, but B, even the negatively geared or not really making any money in terms of rent minus the expenses, but the hope is, the capital growth will be there. This definitely makes sense. Have you noticed this in the culture?
Oh, big time. And Australia was like this just 10 years ago. So there's a lot changing in both markets at the moment. And the real issue is the interest rates and how low the yields have got. So residential property, it doesn't work to go buy 10 houses and negatively gear it, especially now that rates are higher, and they may stay higher, they may go down. It doesn't matter.
Yeah.
It's more the fact you're sitting on a 2, 3, maybe best case 4% net return in your residential properties. And you can't retire on that. Like you guys know how important it is, to build an efficient income for retirement. A 3% net return isn't going to be there. So you're only there for growth. And commercial, I think there's a lot of people defaulting to it because they've got no other answer. So that's the big trend you're going to see in the next few years is people moving away from residential because the numbers don't stack.
Yeah. Well, you say defaulting to residential, or defaulting, they'll end up in commercial because they'll start to see that residential is not working.
Yeah, so those who have the equity or money to consider commercial are doing it in droves now. And it's coming off a low base, mind you. There is still a lot of people, hoping residential yields get better. But look, and I'm a big fan of residential property. I've made a lot of wealth in it. But it's my mantra is you start in it, you don't finish in residential. It's almost, an uneducated way of doing it. Like you're burying your head in the sand of other better asset classes. But you don't start commercial. Like if you start in commercial property, you may get it wrong, because the great thing about residential property is you're kind of protected because it's such a low risk asset class. I'm saying that, with mindful that prices have fallen a fair bit in recent times. But, if you buy and hold long term, it's pretty hard to go wrong in that asset class. But commercial, you got to get it right. But the benefits of getting it right is your return is going to be better.
So do you still have some of your residential portfolio, or are you pretty deep into what would your split now be between commercial and residential?
Yeah, it's a good question. I am slowly selling down all my residential properties except for the one I live in. So the percentage was 100% residential. It's probably sitting at 20, 30% residential now. So I'm heavy into commercial. Like I've got a portfolio over 110 mil Aussie dollars and looking to buy New Zealand as well. But it's really split between like shopping centres, things like supermarkets, industrial assets, medical type properties, and you spread around, and it doesn't sound like it's heavily weighted because I'm spread so evenly with different asset classes within commercial.
Yeah.
But yeah, the residential, they just cause headaches. Like we've all heard the, stories of someone who's got a few properties and it's just maintenance bills going out every day. Like I'm not even kidding. I got a bill this morning for $58,000 to replace a roof on my first property I bought in 2010. And it's like, do I just sell it? Because it's such a dump. Like is it worth putting that capital into it? Because all that capital growth is good in it. This is one of those things all those spreadsheets forget, how much money you're putting back into it to maintain that capital growth. Are there renovations in it to contribute to growth? So the numbers aren't always as good as they look.
And I suppose now with the lessons and the knowledge you have the opportunity cost of capital, right? So you look at it and go, do I put 58 into that to fix the roof, or should I be, taking that cash out and investing it and increasing that commercial portfolio even further, or whatever it could be, asset of choice?
Yeah, 100%. And like the great thing is, like every time you leverage out of residential, you're generally fixing a cash flow deficit and replacing it with a positive one. So it's like a double whammy. Like I was looking at a property we presented to a client this morning, that again, using that $1 million example. It was a 6.8 net return industrial asset in Auckland. They used 40% deposit cash down and the rest was debt. They were paying in the mid sevens for the interest rate. And By the time that debt got paid off and all the outgoings, it was sitting at a 55,000 clear passive income. Now, if you put that same $1 million into 3 residential properties around New Zealand, you, based on a gross yield and pay the outgoings, you're going to be looking at about a negative $60,000. So negative 60 grand versus positive 50, 55, like it's 115 grand difference. Huge.
Wow. Okay. So you go down the path and you end up stacking 110 milli worth of commercial property. That's Aussie dollars. So that's about 3 billion in New Zealand. So, and then when do you get to the point where you go, I'd imagine, and I'm putting words into your mouth, you tell us how it worked, but do you get to a point where you go, okay, there's only so many of these deals I can do myself, but you want to help other people into them. And so then you look at the buyer's agent part of the, your, I guess, journey?
Yeah. Yeah. And look, being completely honest, when I buy a property, it doesn't really, it's not exciting anymore. You buy, like the last few ones I bought, you don't even know when settlement happened. You just get an email from a lawyer and say, oh yeah, that happened. And you think, all right, well, do I keep buying? And the question is no, because like, if you think about like, average capital growth in Australia, it's about 7%. So having $100 million portfolio, like it's almost 7 mil in equity every year you're creating. So you don't need to build it bigger. There's no solution that's going to fix. You're just creating a bigger admin issue. And I've already got full-time staff managing it. You've got people on the ground like property managers. So if we grow it larger, it's actually going to start becoming more of a headache. And
then you won't enjoy it.
Exactly. And that the whole purpose of this was to buy your time back. But what I really get a kick out of is because I remember when we replaced our income, like my wife and I was an engineer at the time working 6 days a week. We literally went to Europe for 6 months, and all of my colleagues and people at uni I went to were like, what are you doing? Like, and they were my first clients because I just helped them buy the exact same types of properties I was buying. And I didn't even know what the buyer's agent industry was. I was just finding deals and doing the due diligence on them and helping them go, he's a good lawyer to talk to. He's the best property manager in town. Like, if you run into problems with maintenance, this is the best maintenance guy, like who won't rip you off. And you just sort of connect the dots for people. It's a service. And fast forward 10 years, like you'd never, if she asked me like 10 years ago, we've done over 5,000 deals and clicked over not far off 6 billion in transactions. I would laugh at you for that type of thing. But it's really blown into a considerable business, and there's over 100 people working for us. And
Sheesh.
And we're in New Zealand doing the same thing, and it's pretty exciting.
Too many of us signed up to a KiwiSaver plan without much thought. And signing up is great, but if you've never got advice before, you could be missing out. Your KiwiSaver account could become one of your biggest assets over your lifetime. That's why getting expert advice early and ensuring you're in the right fund is so worthwhile. Generate have a team of KiwiSaver advisors available to help. Head to generatekiwisaver.co.nz/change to book a no obligation meeting. They can even come to you. A copy of the product disclosure statement is available at generatekiwisaver.co.nz. The issuer of the scheme is Generate Investment Management Limited, and of course, past performance does not guarantee future returns. How big do you see it getting in New Zealand? Because for context, 97% of businesses in New Zealand are less than 20 staff.
Yep.
So obviously, Aussie, you've got a lot bigger economy. It's a big beast. You've got more wealth. You've got more population. What do you think the New Zealand arm of the business looks like from spending time over here over the last little while?
Well, so it's, what is it, about a fifth of the size of the country, Australia. So I look at on population metrics. So we, like, to give you context, last month we helped clients purchase about 180 million in property, Aussie dollar. That's New Zealand numbers included in that. So, but there's not many competitors here compared to Australia. So our market share should be a little bit higher long term. But I'd say a fifth of 180 mil would be our kind of monthly goal of hitting. And it's not really about the numbers. It's more just like we want to help as many clients as possible. Like I've got, as I mentioned before, we've helped 5,000 clients. By the time I'm done, I want to be able to help 100,000. And that's what gets me out of bed, because so many of the people that work for us, people that have somewhat semi-retired from replacing their incomes, and they get bored and they just want to do what I did. But rather than plaster your head and manage a big business, they just want to do it on the side, and they can basically be talking direct with clients, introducing them to properties. Like, we provide the properties. We've got a big due diligence team that goes through everything, and it just takes the risk out of it because our reputation's based on every single property we put out there. So we're quite low risk investors. We don't go for sketchy deals in the middle of nowhere. These are generally like well-known tenants strong long leases, good locations, freehold,
Yeah.
and it does take the risk out of it. And that's I guess where we're heads at with the whole business.
So how many deals have you put together in New Zealand so far?
So it's about 38. So we've done about 90 mil in total.
Wow.
We've been here officially for 9 months, but we didn't really do much for the first 3 months because obviously it's just talk and introducing yourself. So the last 3-4 months have been pretty crazy. So it's gone better than I thought,
Really?
to be honest.
Yeah.
Yeah. So it's really ramping up. And it's just because the economy is suited to this asset class now. Like we're buying at prices 30% better than 2022 prices. So number one, we're getting a really good deal because obviously your official cash rate was a lot higher, 1.75% higher not long ago. So everything's priced at that yield. Now the interest rates have come down so much, there's a differential there, and that's causing yield compression again. And what yield compression is people are paying more for the same rent amount because a lot of the way to value a commercial property is off the rent. So obviously, if people can get bank loans easier or finances, I guess, cheaper, you're going to spend more. And I guess whoever gets in before the full rate cut cycle will benefit the most from this growth cycle. So, yeah, we're going pretty hard because you can see it's a good time.
So I think I read that a lot of your deals, nearly 2/3 are off market. So talk us through what that actually means and then how you come to find these properties that potentially are for sale but aren't obviously listed out there for people to be having a look at.
Yeah, so commercial is a very private world. So think about like the local guy who owns your supermarket. He might be quite a well-known businessman. He doesn't want to go plaster. This happens a lot more than you think. He doesn't want to go tell everyone he's selling that property because one, it could spook the tenant. Two, he might have people in that area that he doesn't want to know about his personal side of things. It's not like selling a house where like you just put it on the open market and there's a mass number of people to buy it. So off market makes more sense from an agency point of view too, because if it's a higher price point asset, there's less mass marketing benefit because you probably know who the rich buyers are in town. So you just go direct to them.
Yeah.
So we are known for that. And it's like a good developer. Same analogy. You're not going to get the best development site going on a real estate site. You're going to get it because someone knows that neighbor who's maybe they've just got divorced and all of a sudden they want to sell quick off market. That's how you get good deals. So you can still get a very good deal online. And I guess the major example of that, or the most common one, is there's been a price adjustment. They priced it too high and we're the first to know it's been dropped in price. So private worlds, off-market deals, it's where the good deals come from.
So practically, do you need to go around door knocking some of these commercial building owners and finding out who might be keen to sell?
Sometimes, but it's more you leverage off the agents because that's what they do. So agents, in a way, almost like our indirect support staff for us because we love working with a good sales agent because they're the ones who've spent 20 years building relationships with all the local owners. But we need to have a relationship with that agent to show we're a deal maker. We've got qualified buyers. We'll move quick. We're educated buyers too. So we'll do due diligence and not because you don't want to buy a property and then freak out because of something that's gone wrong. Like we will know what's wrong at the time of offering. And then we've got due diligence clauses and finance clauses in there to protect the buyers. So you can really, I guess you don't make mistakes and the agents see that as a deal closer. And all of a sudden you just start getting fed good deals. So I guess my business, Rethink Investing, is almost like scaling relationships on a very large scale that kind of bring deals all day, every day in. And still you got to reject 95% of them. That's the other thing. Like even if it's you got to buy the best of the best. Otherwise, what are we doing?
Yeah, you put your reputation on the line and you don't have a business for too long, right? So sure, you could probably cut a deal and make some money, but that's not very sustainable long term. So you must chew up a lot of time doing due diligence and whatnot for deals that don't then go through, right?
Correct, yeah. And it's one of the costs of doing business. So a due diligence process for us or our commercial process is quite extensive. It's over 100 points of checklist. So we got to go and understand what the council regulations are. Has that tenant registered for this property? Who owns the fit out? What's the make good provision on it when the tenant leaves? Is the lease fully net? Like, they might say one part of the lease that the tenant pays 100% of the outgoings, but then it might say, well, they don't pay for aircon maintenance. And then you've got to actually work all that back into the numbers. Yeah. So you're basically auditing the property. And then you get your building and pest report. you've got to then check every little detail there. You've got to get your service history of, like, there might be conveyor belts in there, or, you know, a roof that's getting aged. So you've got to price it all in. There's a lot in it. And if it doesn't go through, we're actually happy because we dodged a bullet. But if it goes through, then everyone's happy. It's a good deal.
So then how do you guys get paid?
So we're commission-based, so we get paid on settlement. So, you know, I'll tell everyone we charge 1.9%. The way that works is, you know, it's $1 million property. There's a 19 grand fee in there, but we're not even going to show you the deal unless we're negotiating, in that example, more than 19 grand off. So you're going to be ahead day one through negotiations alone, hopefully 4 to 5 times over as well. So we'll get that back easy. You're going to get value through the off-market deals, but the most valuable part's the due diligence. Like, you're going to find problems with every deal just on little scales. Like, it might be a leaky gutter that needs to be reconnected, or it might be there could be a structural issue, or we call the tenants up, and, you know, when we've done this thousands of times, you can smell a rat pretty easily, and you go, well, maybe that tenant's related to the owner and they've put the rent up a little bit higher, and there's a game being played here we need to walk away from. And hopefully we know all that before the offer, and we generally do. So that, I guess, that selection process of rejecting properties, a lot of that gets done before the client sees it, but we still need to get into the nuts and bolts.
In New Zealand, it's been a bit of a tried and true path where you might build a business, you might then buy a personal property and you run that side by side, and then you sort of get to the stage where you approach your landlord and offer to buy that if you're going to continue to run the business, and then you sell the business and the building as one asset in the future, maybe, or maybe that's what the plan is. I wonder if you were going to get approached by people that are looking to buy property, commercial property that they're going to stay in, and get you guys to do a little bit of that DD, or what do they need to be mindful of? Because I think for a lot of Kiwi people who do that, it's basically, well, we think it's for sale, get some legal and some accounting advice, and, you know, maybe get a builder to take a bit of a look over it and just charge on and see how we get on.
Yeah, look, it happens a lot. There's obviously a lot of owner-occupiers out there, and it makes sense, especially like in certain asset classes like industrial. It's so expensive to rent because rents have gone through the roof since COVID, because e-commerce has flown up. Even building replacement costs, like every time that build cost goes up 7 or 8%, that's how much it costs to rebuild the thing. So because build costs have gone so far high, there's really not much ability for them to supply new supply. So that means all the existing stuff just gets more and more expensive, especially from a rental point of view. So, yeah, a lot of owner-occupiers want to, buy their own premises, and we don't do huge amounts of that. Like, we generally advise, like, try keep your business and investing separate. And the reason is, like, the best investment area is probably not going to be exactly where your business is. Maybe it is, and you'll be very lucky, but there might be somewhere else which will give you a better return. You rent, like, especially if you're in like a real blue chip suburb where it might be a 4% net return to buy the property, that's cheaper to rent. I'd rather go buy somewhere else where it might be an 8% return. So you're getting twice the rent somewhere else, and you've paid for your rent, but you still got an asset producing capital growth in a different part of the country. So
then probably not exactly your game, but let's say there are some people who are potentially going to buy the commercial building that they're operating in at the moment. What are 3 things that they probably don't think about or commonly get wrong if they were to buy that commercial building?
So number one, just understanding how to value a property. Like, no one really knows how to. Like, you've got to go in, like, it's not like a comparable sale analysis in residential. You've got to work. There's a few ways to value a property, but the main one is find the square meter rate for the rents, and then the market cap rate, capitalization rate. It's pretty hard to find exactly what rents should be without going direct to property managers. So you talk to them and say, what would this rent for? And then if that was rented, what would it sell for? And then you can kind of value it, number one. And another mistake I see is business owners wanting to buy, but their business is either growing quickly or going the other way. Well, there's no point buying a property you're only going to need for 3 years. Like, especially if you're a successful business, you probably need something twice the size in 5 years' time. So just rent, and then you're not having to deal with selling out at a less than ideal time, or you, like the lower yielding example I mentioned. Like, the office I've got in Australia, like, I've rented because I'm like, well, we're changing sizes. You know, you don't need to drop all your money into a deal just because you're there. You just let someone else rent it to you at a probably cheaper rate. especially the way interest rates are, it's probably cheaper to rent. So and that's probably the third one, just rent versus buying analysis, where's it at?
It's almost being unemotional with it, which is probably blasphemy in New Zealand, because we see rent as a waste of money and whatnot. And I think slowly we're learning, okay, maybe, there's nothing wrong with renting whilst it's fit for purpose for where you are. I want to take us then to, because I think for a lot of people to think about investing into commercial property, this would just be, wow, I'd never considered it. Don't even know if I can. How is it different to residential property? So what things do people need to normally have ticked off before they can explore whether it's something that's right for them?
Yeah, great question. So minimum deposit, cash or equity, you need about 400,000 now. So this is not me saying that this is open to everyone in the market. This is a space where you go if you're in a good position. It's where you want to go if you're really wanting to retire and you've got that capital benefit, and that's where you'll do the most benefit, because like I mentioned before, if you spend $1 million, you're going to get a 55, 65 grand passive income plus capital growth compared to negative geared 60 grand. So that in itself is the reason people have to look at it. There is higher risk if you get it wrong, and how you can get it wrong is just over-rented properties. You pay too much, you misvalue it, you buy a dud, you haven't done your due diligence. So you can kind of engineer your risk away by just doing your homework properly. But you got to know how to do that homework. So I think the way the economy is now, there's a huge amount of baby boomers transitioning into retirement or well into it, and they don't have the cash flow. This asset-rich, cash-poor scenario you hear so much is what you got to turn around, and you got to target higher yielding assets, because there is a flight globally towards high yielding assets because we need it, especially if there's a lower growth forecast. So you see what's happening all over the world. There's a chance we're going to get less growth than what we've seen in the last 40 years, especially for residential. Because think about residential property in the last 40 years. Investing became popular. Women entered the workforce. There's just so much more focus on pushing prices up, all these government initiatives to help things along. And it's kind of created by a multiple of your average income for the household, it's super unaffordable now, residential property. So would that asset class keep growing at the same rate of the last 40 years? I would argue not. So if you're getting lower growth and your yields at record low, you're where do you go from there? And I'm an investor. I don't care for commercial other than the fact it gives good returns. It might be a totally different asset class in 20 years for me. Residential's where it started. It's now commercial. I can see a great pipeline of opportunity ahead. But you don't keep flogging a dead horse. And that's kind of what everyone seems to be doing with residential. They keep going down that route. Residential is amazing to leverage. It's a way to get out of the middle income, lower income to that next level, because you can put a small deposit, 80, 90% loan it, and build wealth that way. But once you get to that kind of next level, you got to move into asset classes that make sense. And that's what every family office in the world does. They own, family offices. We work with a lot of them. They're some of the most sophisticated investors on earth. They're the ones that own office towers in the city, and not the best example of that, but they've got a higher percentage of properties in commercial than residential. They don't go buy 30 little houses out in a small town. They go buy the trophy shopping centre in that area because it gives them a better return.
Yeah. I think that'd be, for New Zealand, I think we're a lot further behind with some of what you're talking about. But traditionally, it is buy your own home, leverage off of that equity, get a rental property. But even now, our median rent, say it's around 600, but let's say it's 700. That's 35 grand of income for the year. You then got rates, you've got property maintenance, you've got accounting, you've got insurance. You may have interest on that. Even once you subtract all of those things on a freehold rental property, then it wouldn't have interest or the mortgage payments, but it might only be $20,000, which isn't a lot. When you say, get a property plus a rental, you kind of think, you're set for life, but you've still tied up all of that cash in that rental property and the owner occupied. And that's what I think people are starting to come to realize, they're looking further down the path than just sort of definitely do this. The number always goes up. It all makes sense. And I think a lot of people don't want to go and get a second, a third, and a fourth, and are starting to rethink, okay, what is going to be their strategy for passive income? Yeah,
and you said it perfectly. That's been happening in Australia for a long time. It's happening in so many parts of the world. the housing model, it's a little bit about out of whack at the moment. And, with that 20 grand, with all that capital you've invested, and then what happens if it doesn't grow at the rate you needed? You're actually getting a very poor return on equity. You need to consider other asset classes, and that's what we're here for. We just want to educate the market. We're not saying just go buy any old commercial property. Like, you want to be quite careful with certain asset classes, like office, like especially the high-rise stuff, but maybe a little freehold office with a doctor and a lawyer and accountant in it, that could stand the test of time. Like, there's nuances to this, but I've got so much experience, like in the billions of dollars amount in Australia, and it's changed hundreds or thousands of people's lives, and it's only gaining momentum. There is a massive shift away from residential to commercial, but the shift is definitely not there. Like, you still need to start in residential. That's the thing I want to highlight. You don't just jump in to commercial with no investment experience, because what if you did lose your tenant? You haven't hardened yourself dealing with little tenant problems in the residential field. Like, maybe you've been a big share investor and you've dealt with ups and downs. Like, you have to be hardened like that to be a good investor. And then if the bad day comes with commercial, which it will, you'll lose a tenant eventually, and you'll go, all right, how do I fix that? This is a chance to solve a problem. Do I need to go reach out to competitors? Do I need to refit the property? Do I need to, chop it up into smaller blocks and put some retaining walls in it and then lease out to multiple tenants? Like, you've got to fix things like that. And that's what the good investors do, rather than freak out and sell.
Yeah. There'll be people that aren't familiar with buyer's agents. Can you just give us a little bit of a distinction between a real estate agent, which we're probably more familiar with in New Zealand, versus a buyer's agent? And interesting, I got called by a buyer's agent in the residential space a little while ago, and they were from Sydney and had moved to New Zealand, and was like, "Oh, you guys don't really do this here. This is what I do." And I was like, "Oh, this sounds great. They go and do everything for you, and I don't have to get involved in it." But what's the difference between a real estate agent versus a buyer's agent for those people who don't understand?
Yeah, it's a great question. Probably one of the biggest ones we've got to echo out there is that a sales agent represents the seller. There's a lot of people out there, when they buy a property, they think, oh, the nice sales agent is, so helpful, giving me the information. Their entire job is to maximize the price and sell it. So do not ever confuse that they're there for you. You're there to give them the money at the end of the day, and we're the opposite. So we're a buyer's agent. We represent the buyer. My job is to get it for the cheapest possible price. We don't get paid from the seller. We're not incentivized by sending you any specific area. Like, we've got the whole market to choose from. A sales agent, because a lot of people might go, oh, I'll just call up Colliers and see what they've got. Colliers are only going to show Colliers properties, probably in that one market. But a buyer's agent will go, well, look, we're going to look across every single agency, on and off market, all the different markets, and all of a sudden you're looking at 10 times or 200 times the deals.
Interesting, yeah.
And you'll get more value out of picking the right asset than trying to go through someone who's just trying to sell you something.
Yeah, I think it's something that we'll probably become more familiar with here in New Zealand. It's just probably relatively new for a lot of people. I think Kiwis are quite skeptical, and they think, someone's always trying to get a deal out of them. But from how you guys would explain it, you're basically working in the buyer's best interest, right, to then put the best quality asset in front of them. Yeah.
And I'm like, we're the largest commercial buyers agency by a mile in Australia, probably 5-6 times the next competitor. And I've negotiated more properties than I could know, but I would still use a buyer's agent for residential myself if I was buying a home in my local area. The reason is they've got access to deals. I'm not talking to their agents. Sure, I can negotiate any deal, but I want access. And that's what a buyer's agent, a good one, should give you. And, anyone that's too arrogant to admit that, they can't get access that someone else could, then it's their loss. Yeah. There's a lot of great negotiators out there. A lot of people use this because they hate negotiating. That's a different thing entirely. But it's all about access and obviously de-risking the exercise.
What are some examples of the New Zealand properties that you've purchased so far in your short term? But it doesn't sound like you've been mucking around, that's for sure, that would give people a bit of an understanding of the types of property that you're buying and maybe even for who, without obviously naming who these investors are.
Yeah, it's a wide range. Like, as I mentioned, there's 30, 35 odd deals we've done, and they're mostly just experienced residential investors that have kind of dealt with the cash flow issues, or one of them sold out of a business and had a lot of equity. So it's a place where you go if you've got a lot of money, because you'll buy extremely well. The more money you spend in commercial, the less risky it gets. And that sounds a bit crazy, but this is why I said there's a minimum 400 grand amount needed, because if you start playing in that sub $1 million price point, you're dealing with smaller tenants, shorter leases, more stock. They're just things as a brand and as a long-term investor I'd rather avoid. Like, it's just hard, because a good small business is going to become a big business and leave you. You know, a small business might struggle, like statistically, the higher failure rate at the smaller price points. So the bigger ones, you start dealing with national brands on 10-year leases, and they've got the best corner site in that location. Even if it's regional, it might be like the number one. You know, think about McDonald's. Like, if you might be next to McDonald's, or you buy the McDonald's. Like, it's a rock solid deal, and it costs more, but it's lower risk. So. You know, people that sell out of businesses, or they've sold out of a bunch of residential properties, they'll all drop it into one or two very good quality, you know, what I call intergenerational type deals, and they never sell. It's the last thing they'll ever sell. They'll literally pass it on to the kids and put in a will for the kids not to sell, type of thing. So, they're Kiwis that are done well in life, but they're needing income to solve their own, you know, retirement goals, and it's building momentum quite quickly.
So we're talking like medical centres, industrial sites, offices, logistics, all angles.
Yeah, so the ones you mentioned I love. Like, I love logistics because it's a growth industry. Like, think about an industrial warehouse. That's just a shed, you know, but the shed is quite large. You own the freehold. That freehold is getting increasingly expensive. Like, the two sub-segments of Australia, the number one markets for the last 10 years was Brisbane. No, it's not Brisbane. It was Melbourne freehold industrial and Sydney. Sydney grew 280% in 10 years, so 28% per annum on average, and Melbourne 281%. Wow. Massive growth rates, plus good yields on top of that. And you just want a piece of that. So industrial should be right up there. What would hurt industrial? Not much, because build costs keep going up. It's cost a lot to build a big shed. It's still at record tight vacancy rates. Like, it's about half what the long-term average is in New Zealand. You know, you're under 2% in most markets, and generally they sit at 4-5% long-term. They're just tight markets, and obviously with the internet, the way it's going, everyone's buying, selling things. Like, you just need to store this stuff, and you know, that last mile logistics model is just getting more and more strong. So industrial, love medical, aging population, expensive fit outs, recession-proof type tenants. Like, it's pretty hard to go wrong there if you buy something that's up to scratch in that range. As long as they're paying a fair market rate and you're not getting, because that's one of the risks with that asset class. Has the doctor, is he the owner? Has he pumped the rents? Like, you know, you got to value things correctly in that space. It's a little bit trickier because, you know, what machinery do they have in there that might, you know, add value to it? Like, you know, some of the stuff they have, MRI type things in there cost huge amounts, and that kind of gets built into the security because it's harder to move those things around.
Gotcha. Yeah.
I love those like little neighborhood shopping centers, mixed use. Reason is they've generally got a small supermarket, good market to be in. They might have a pharmacy, also good. 3 or 4 food related, like a bakery, a pizza type joint. But they all feed off each other, and there's a little critical mass that's formed where it starts becoming a destination, and then all of a sudden the whole thing's worth more. And you can monetize all sorts of things in those. Like, you can put EV charging into the things. You can put solar panels on the roof, and that all gives you extra income because you own the whole thing. Battery storage is a big one in the renewable space as well. There might be a vacancy you can fill for upside. There might be, maybe you just render the whole place, give it a big paint job and make it a high spec place. That all adds value, and value adds are a big part of what we do in commercial.
Do you have capital gains tax on the gains on these properties in Australia?
Only when you sell.
Okay, only when you sell.
Yes.
Whereas in New Zealand, I'd imagine it's a bit different. Where at the moment, our capital gains aren't really taxed in that space as well. Yeah. So you're kind of doing what people tried to do in New Zealand on residential property. You're sort of doing it at scale with more asset base underneath you to grow at the same time. Oh,
it's fantastic, New Zealand. When I heard you got no stamp duty and no capital gains, I was like, is this a joke? Like, we're taxed so heavily in Australia, and to keep, like, we did a deal the other day, and the stamp duty was like 1.5 million on it, like cash gone to the government, stamp duty. Like, and these higher price point ones in New Zealand, you don't have that. So it's a reason for Australians to consider all right, well, yes, it's a different country, but it kind of feels like another extended state of ours. The same brands are there. It's we've got treaties between the countries that make life very easy to move and invest between the place. So why not consider it? Because the tax system is better than what we've got.
Yeah.
And that's the other elephant in the room. Like once the Australians, because the market's getting more and more expensive there, once the value is not there for Australians in Australia, they're going to buy up all of New Zealand. And that'll push growth up, prices up as well.
Yeah, I was just thinking that, we're going to see more of that because they'll be, the more they get educated about it. And I've heard recently a lot of chat about people Australians buying property in Queenstown, for instance, as well, and then choosing to live here later on, and then bringing that wealth with them. And yeah, it can be fascinating to watch play out. Just on the tax side as well, we've gone from a Labor government who basically wanted to reduce. They had interest deductibility. Yep. So did you see that about
yes.
that? Yeah. So and then that's been phased back out by the next government. But I guess there's nothing to say that future Labor government don't reintroduce that. Maybe not. But I think people probably don't, because they don't understand commercial property to the level that they do residential. Interest on a commercial property is 100% tax deductible, and those are separate rules from residential property again. So, yeah, I suppose it's an asset class that at the moment is a little bit protected, especially when compared to Australia. But then even when we compare it to our own residential property rules here in New Zealand.
Yeah, and it always will be.
Yeah.
And the reason is no one cares about it. Everyone's so focused on the political side of residential because it's topical. Like, rents have gone up. You got to, immigration levels are too high. They're taking our properties. All that kind of stuff is a residential chat. In commercial, we're never in the spotlight.
Yeah.
So, and it's very important to have an asset class that won't have those shocks in the system because, you've had it. It's going to happen in Australia, and I keep saying it to my Australian audience, is like, don't think that the rules you've got today are going to be there forever because every state government's changing things more and more tenant-friendly. And when the population base goes over 50% tenants versus the others, all of a sudden it's going to go further that way. So there is genuine political risk for both our countries in the residential space, which you need to be aware of. And that's why you don't go too hard, too long into that. Because you don't want to get caught leveraged up in a big portfolio and all of a sudden there's a maximum rent you're allowed to do, or they take the interest rate out, or maybe they start taxing on unrealized gains. I don't know. There'll be something there. Yeah. And that's where the risk can be.
I find it fascinating speaking to somebody like you who comes to New Zealand, but also comes from a background of property. But like a lot of the things that you're talking about in terms of residential property, Kiwi people will not think about, nor like they won't go down that path because it'll kind of be she'll be right, surely they won't do that. But the beauty with what you're talking about, I think with commercial property, you're sort of then forced to understand business as well, demographics and aging populations, and even just like looking at risk in a very, very different way, which is cool because it's like anything. Once you start learning about something like residential for yourself, you then compound those lessons into the next thing and then the next thing and then the next thing. And I think it's a good reminder for all of us just to keep our learning going and be open-minded to the changes that can come.
Yeah, and there's definitely going to be changes as well. Like it's I guess there's more and more people that won't ever buy a house anymore. And that's, like, you think, what's a politician's job? To get votes, So if they bring a policy that affects more people that vote for them, they're not going to protect investors if we're the minority. So get ready for that, invest and spread your risk around, and that might be different countries or might be different states or different asset classes. But you got to remember politicians are there for votes, and the minute the majority goes a different way, that's when things happen. Yeah.
Well, you're making it almost sound a little bit too easy, and maybe that's because you've got 110 million of your own in terms of commercial, and you've done $6 billion worth of deals. But what are some of the risks that people face when they invest in an asset class like this? Because with every investment, there's risk, right?
Yeah. So generally with commercial property, the results are faster and hyperinflated. So when the economy goes worse, it happens quicker. And that's because like the valuations tie closely to interest rates. And, that's why you would have seen the office market being one of the first to drop when COVID hit and the last to recover. But when it recovers, it's a lot faster. So it's basically like investing on steroids. So You generally will find that people like that and can benefit much faster. But it's the everyday people that get hurt by that. It's almost like crypto in a way. There's, obviously there's some people that do very well, but there's many that don't. But things happen quickly and you've got to be ready to invest. But I sort of tried de-risk that by just going for good old classic boring type properties that are recession proof, that have been around for a long time. So you can maneuver around the risk easier, but the everyday person might not. You generally need more capital. So the risk is if you start playing in that entry-level space, you're going to deal with more vacancies, more turnover. It's more technical, so that you're dealing with sophisticated negotiators. So if you're the first time coming up against a Barclays agent who's done this for 30 years, you will lose, or you paid too much. Like that's the risk. You've got to be very careful because that's one of the risks, overpaying for an asset, even if it looks good. And the good ones are the ones people overpay for, like the childcare on a 15-year lease. They'll go, oh yeah, I'll accept a lower yield because it's 15-year lease. And that slightly lower price point, or the yield they accepted might be 20% in price, and they've just pissed that against the wall.
Yeah,
and they won't even know what they've done. But it could be $1 million they've just lost through paying too much, because you can't value an asset that doesn't have huge amounts of comparable sales. So the vacancy one is, so the way I explain vacancy in commercial is it's all bottled into one section. So over a 10-year period in residential property, you might on average have 4 weeks vacancy per year. So over 10 years, that's 40 weeks. With commercial, you might get like 6 months vacancy, but that's all you'll get for 10 years. So it's all, consolidated in one position. And in the middle of that 6 months, it's a pretty dark and lonely feeling. If you're, got some bills to pay and you've got no tenant there, so you've got to be prepared for the longer vacancies. But remember, the longer vacancies come with much longer tenure. And I've had many tenants that will probably be there, by the time I'm done, because they just get resold to business owners or, ASX listed companies. And so they just stay longer, but they do cause longer vacancies.
It's interesting because I spoke to a few rental property owners, residential, in this downturn here in New Zealand, and not only were they complaining about having to top them up because of interest rates going up, the odd one had a vacancy, and it's a bit like what you're saying before, the loss is magnified even more because all of a sudden you're effectively paying what they normally would be in rent, plus then topping it up.
Yes.
And if you don't have enough capital, then it puts a squeeze on the old household budget pretty quickly. So like you say, you've really got to know what you're in for, right?
Exactly. And you just need to be experienced as an investor. It's not a place to go in. You can obviously use buyer's agents to fill gaps in, but with all my clients, we try to educate them through the process. We're not, this is my engineering background. I'm not a salesperson. I present numbers and the deal will sell itself.
Build shit and fix shit.
Exactly. But you can't expect to hard sell someone into a $10 million asset, because they'll just walk away, and that's where the residential side is very different. I love working with commercial agents too, because they're sophisticated as well. They're a different breed, and there's sales agents in the residential space are the best marketers on earth. They've got massive strengths that some of the commercial guys don't have, but it's a totally different vibe when you go against them. It's about the numbers, the deal, disclosure of things, and that's if you know how to work with that type of agreement, you won't make mistakes.
I was doing some background digging before we chatted, obviously, and I saw that you've got a knowledge hub on the Rethink Investing New Zealand website, which is an investment guide effectively. Because what I was going to ask is, do you get people who come to you who think that they're ready, and you basically have to say nicely, no, you're not actually cut out for this or ready, or this isn't your asset class?
Yeah, it happens less and less. When I first started the business, it was no one had a clue with commercial property, but a lot of them listen to the podcast, and in Australia, we've been running our one for 6 odd years. So some of them binge that, and you'll learn so much about it. The great thing is Australia and New Zealand, the skills are transferable. So once you understand what's going on there, it's the same. There's just slightly different tax and lending rules.
Yeah. Well, that's what I was going to ask. Can people listen to the Australian podcast, so the podcast that you guys have, and learn a lot about commercial property that will be applicable here in New Zealand?
Yeah, exactly. So that's we've got a book, Rethink Property Investing. If you just go onto Amazon, that's spend $20 odd there, and you're going to get our life story on commercial property. The highest level education tool we've got's called Rethink Commercial Education, and I brought that in for the exact reason you just mentioned. We like dealing with educated clients, like, because you don't want to be sort of dealing with someone who's super nervous and doesn't trust anything. Like, the more they know, the better, because we're just presenting the best deal they can get for their money. We've done all the leg work for them, and the most educated ones are the ones that are the easiest to deal with. So it's kind of a selfish thing in a way, but they're making their own call. And that's like, we help fund managers buy properties because, they're some of the best investors on earth, but they don't have the networks we do. So they'll just leverage that. They'll do their own DD in that because they can and they need to. But but they just want to use us for sourcing because that's what we do best.
So that must be pretty awesome to think about your journey where you're at the point where, so if we put it in Kiwi language, KiwiSaver providers would effectively be coming to you saying, hey, we need you to find us good commercial properties to invest in on behalf of all of our KiwiSaver members so that we can get a good return and we're comfortable owning this. So that's part of what you do for a living.
Yeah, exactly. It's like treasure hunting this thing as well. I love the deal. Finding a good property where someone's made money from buying under market value. The yield's better than anything they've seen. Like, it's fun. It's a good feeling, and then people actually, I've seen hundreds and hundreds actually fully retire and they're just living off the rent. And when the market has pushed you a different direction for the last 50 years. And they've seen this new way of doing it, like, you're responsible for them taking that directional change, and it makes the whole thing more worthwhile.
It'd be a great feeling. All right, so there's a few resources if people want to go further down the route and learning from Scott and his team. So you've got a book that people can find. There's the podcast as well, and then you've got the rethinkinvesting.co.nz/knowledge or -hub. But if people search for Rethink Investing, they'll find all of your resources, right?
That's the easiest thing. Just Google Rethink Investing in New Zealand. And look, if you want to chat about your situation, it's all about just seeing what's out there, obligation-free chat. And we just want to sort of show you more of what we're talking about, but going to the specifics about your position. And then, we've got financial planners and that type of stuff working for us. So we'll, look after you.
So a question then, who's buying New Zealand commercial property at the moment if people aren't doing it? Like, is it fund providers? Is it, big wealth funds? Like, who are you seeing mop this stuff up? Because, and then second question, or maybe let's start there and I'll go to my second question as to why I'm interested in that.
It's a good question. Because it's changed in recent times. Fund managers are doing a lot less. And one of the reasons is they got liquidity issues because they purchased properties pre-2022 and they've got leverage on it, and the debt's a lot more expensive now, and the yields they bought it weren't super high back then. So as the interest rates have gone up and the yields haven't caught up, they're not in a position to invest as much as they once did. In fact, they're selling. A lot of them are using that to free up liquidity to pay investors out, or they're not paying them in some cases. So they're not active, they're sellers. But the active buyers are individuals. And this is the same thing in Australia. Those individuals are cashed up business owners, people that have sold 15 houses, or maybe they've got an inheritance or whatever. They've sold their family home and they need a retirement. That's what's happening. So it's individuals buying, and their percentage has gone up over 50% now, and the rest of the institutional guys.
Far out. Okay. So, because what I was thinking about is, as a country, New Zealand has a higher level of older business owners than other countries in the Asia Pacific region, I believe. And there's sort of whisper that with that aging business population, that they either sell those businesses, but then younger people can't afford to buy into them, or maybe by the time they get to that point, they're ready to, they simply close them down, or the other school of thought is actually they're severely undervalued because younger people can come through and go, oh, we actually should be doing it like this. We can add value really quickly, and that's going to be fascinating to play out. But I would imagine that the average age of a commercial property owner would probably be in New Zealand a bit higher. And interested, do you guys look into all of that data to figure out who owns all of these properties, what sort of stage are they at, and what's going to motivate them to potentially sell? Yeah,
look, without generalising, they are generally fairly older. like, the amount of 80, 90-year-old sellers we deal with, it feels like every second time.
Okay,
But
yeah.
I don't have the statistic on it, but yeah, they're older, wealthy people that have probably bought the thing 20 years ago and, like you said, got good businesses or whatever behind them. Yeah, it's a really interesting period in time as well because, like you said, all the baby boomers are selling out of their businesses, and there's going to be a period, this is my prediction, a lot of these individual businesses will get bought and consolidated. So you think about like legal practices, accountants, like there's no people buying into them. So maybe they're bigger companies that'll just buy them at a pretty low multiple and then kind of run it into their business at a higher multiple, so they absorb a lot of these businesses. So you'll see less small business and a few larger ones come into it, which could be really good in many cases, like it's happening in many pharmacies or legal firms, mortgage companies. It's just a trend. So it's not super relevant to what we're talking about. But again, you've got to understand every aspect of the market so you can predict things. And I'm predicting, there'll be consolidations of businesses, less owners, but with bigger businesses.
When you're dealing with these older ladies and gentlemen that own these commercial properties, two things. Do you gain any insight as to like why were they doing it 20, 30 years ago? Like why did they get into that when traditionally in New Zealand there would be an outline to be like, hey, you should be doing the property thing. You should have 9 of them by now. And then are they fascinated by someone as young as yourself, just, full send, just getting into it?
Yeah, look, good questions. Generally, they're business owners. So they all start and buy their property and go, oh, the business is still going well, let's buy another one. And that's kind of how it happens. So people own sheds, medical professionals, that kind of thing.
Yeah.
Look, the owners, they're an interesting one because a lot of our buyers are quite elderly too. And one of the interesting dynamics we kind of run into is, especially in the higher price points, these are the guys buying like 10 mil plus things. There's huge egos either side of the fence. So, like a lot of our kind of rural clients, they've done incredibly well for 50 years. And then if a seller says, oh, I'm not fixing that thing, then they get the shits. And then it's like you can have Mexican standoffs over like $50 items sometimes. So you feel like you got to be a psychologist sometimes, counselling to say, let's not shit the bed over a silly thing like this. So big egos are all part of it because they've both done well in life. So, business or investment related. And but the good thing is we're in between it and there's generally a sales agent in between it. So we don't really deal too much direct with the owners. We prefer an agent there because they're managing them because we're still the enemy because we're a buyer. They feel like we're taken from them, and a lot of them want to choose who they sell to as well. That's a big thing. They don't want to sell to certain types of people for whatever reason because of their own biases. So you kind of got to get in between and smooth things over.
Yeah, geez, you really need to turn the engineering brain on to solve some of these things. Yeah. Is there anything that we've missed through this conversation? I feel like we could talk for ages, and I think we're probably going to have to do a part 2 at some stage as you guys continue your journey here in New Zealand. But maybe just how people can get in touch or stay closer to the work that you are doing, because I think more and more people are going to, find out about what you're doing. And I think there'll be a lot of people that do want to learn more about commercial investing. Yeah.
Look, just Google Rethink Investing. We're here. We've got New Zealand staff here working. Like it's a although we're Australian kind of by heritage, the brand is like we're New Zealanders helping New Zealanders here, and they're the local experts in that. But yeah, look, it's going to be a big thing. Buyers agents and commercial property. You watch the next 5 years. It's going to significantly change and gain momentum. And the early adopters always benefit the most from the capital growth curve. So if you sit around waiting for 2 years, you're going to miss 2 of the best years of growth because those official cash rates are still coming down. Even if they don't, the current ones they've priced in haven't fully gone through to the market. So you're going to have a quick win on growth. And then you're left with a great residual income of, 6, 7, 8% net return anyway. So it's kind of like the return on equity is going to be hard to beat in this space.
Did you say that you've got 20 buildings under contract at the moment in 1 month alone here in New Zealand?
So that was over a couple of months total, but they're currently under contract.
Gotcha.
So like that equated to about 45 mil in property. So it's starting to go pretty good. So people like the product. So, and we know they will. It's just awareness really. Yeah. So.
All right, before we let you go, mate, what are you noticing in New Zealand as a vibe and maybe economy and maybe what you pick up in the media versus Australia? Anything that stands out when you jump between the ditch?
People are more friendly here. I don't know why.
Yeah,
I think,
yeah.
like from a business point of view, it seems a little bit less cutthroat. Maybe it's almost like what Australia would feel like Americans are. I don't know. That's just a silly analogy. But no, people are very welcoming, like, because we've gone in pretty heavy and hard into this market and spoken to a lot of people. And, even the sales agent industry, because some of them would do buyer's agent work on the side. And, that in a way, like, that's not a buyer's agent, by the way. That's someone just taking payment both ends of the stick, which is not a good thing. But you got to represent one side or the other, period. But look, people have been very welcoming, and I find it's very similar, to be honest. Like, it's the same brands. Like, there's so many New Zealanders in Australia. We're probably half New Zealander ourselves over there. Like, the parts of like Gold Coast and Sydney. It's crazy how a lot of you guys seem to be moving over there. But yeah, there'll be a lot of people move back because New Zealand is more affordable, and obviously it's a beautiful country. And I like your economy, and so does a lot of the rest of the world, because it's viewed as secure. It's got obviously agriculture base, high tourism. It's it's a pretty, it's an exciting place to kind of park money up and feel safe about it as well. There's a lot of countries you can't say that about in the moment.
Yeah, I do think that when you live and breathe New Zealand, we probably feel like we're heading in the wrong direction, and we're in an economic lull, and we've had an engineered recession and inflation and interest rates and all these things. But it's refreshing to hear people from the outside looking in still seeing New Zealand as a really good country to live, but also invest and to want to do business and transact.
But it's the same in Australia. Like, we have so much negativity all the time. And like, I spend 4 months a year in Europe because we live in Greece. Like, my wife's half Greek. And when you turn on that European news, Australia never comes up, or New Zealand. Like, nothing exciting happens here, like globally. It's such a quiet little place. Like, even if we're in the middle of an election, that just barely makes it to like the 50th story on, Euronews or something like that. Like, so nothing really happens, and that's a good thing. It's stable. It's almost boring in nature, but just remember that at the end of the day, like, it might be feeling worse than it is, but that's because the media sells the negativity.
Yeah, it's such a good point. I haven't done a lot of traveling in my life, but as I have done a little bit more, I kind of get engrossed in wherever I am, and then I'm like, oh, I wonder what's happening in New Zealand, and then I'll jump into the media, and I'm like, oh man, and it's like that's the big story.
Little industrial fire here, or someone got stabbed. Like, it's like they're nothing in the global scheme of things. And I think we're both very lucky countries, and it's great places to live in. Most of Asia would love to live here, and that's kind of the I guess the silver bullet. Whenever our economies go bad, you just let more skilled migrants in with money, and our economic woes go away. It causes other problems, but from a recession point of view, you can avoid it through immigration, and that's something many countries could never do.
Yeah. All right. Well, Rethink Investing are on Instagram, I believe, and obviously you've got a website packed full of resources, and there's an ability to reach out and speak to somebody. 100 staff. That's a grunty-sized business, mate. So yeah, looking forward to seeing the progress that you guys make in New Zealand. Like I say, we'll definitely do a part two as you guys go further down this path. But yeah, again, if people want to reach out, I'm sure they can do that, and it won't be hard to find by having a quick Google for Rethink Investing.